The most dangerous market is not the one that is falling apart. It is not the one rocketing to the moon. The most dangerous market is the one that does nothing. The quiet, listless, sideways market is where more accounts are ground to dust than in any spectacular crash. It bleeds you slowly, not with one catastrophic blow, but with 1,000 paper cuts. It preys on the most destructive human impulse a speculator can have, the need to be doing something. It whispers to you that your inactivity is a wasted opportunity, that fortunes are being made in the small wiggles, and that a master trader would find a way to profit. This is a lie. This lie, if you believe it, will cost you everything. You are not paid for trading, you are paid for being right. And in a quiet market, there is nothing to be right about. The lessons I'm about to give you were not learned in a library. They were paid for with millions of dollars, lost and remade, time and time again. Each rule is engraved on my soul by the searing heat of a margin call. These experiences are all documented in the book, Reminiscences of a Stock Operator. If you wish to save yourself the tuition I paid, you will find the link in the description of this video and read it until the pages fall apart. For now, listen. Your financial life may depend on it. I will tell you about a time I was certain about cotton. I had done my work. My analysis, what some men called my dope, was sound. I knew with every fiber of my being that cotton was destined for a great advance. I established my position. I was long and I was right. And then the market went to sleep. For weeks it did nothing. It would rally an eighth and fall back a quarter. It would sit motionless for entire sessions. The price feed, what we called the ticker tape, became a monotonous drip, each print a fresh torment to my conviction. My mind, which required action and confirmation, began to turn against me. Was I wrong? Had I missed something? The quiet was unnerving. The absence of a trend is a psychological torture chamber. So I began to trade. I would sell my line on a small rally, hoping to buy it back a little cheaper on the inevitable sag. Sometimes it worked, sometimes it did not. I was scalping, trying to pull rent money out of a market that had no direction. I was listening to the devil of impatience. I lost my broad, strategic position for the sake of a few meaningless ticks. My main line, the one built on my core conviction, was gone. I was now a day trader, a gambler, guessing at the direction of ripples in a stagnant pond. The small losses began to mount. They were nothing individually, but together they were a steady drain on my capital and, more importantly, on my nerve. The market was wearing me out. I grew disgusted with cotton, with my own foolishness, with the entire game. My analysis had been correct, but my actions were those of an amateur. I could not stand to look at the board anymore, so I did what any man in that position would do. I sold everything, closed the book on the trade, and left town. I went on a vacation to escape the market that had refused to do what I was so sure it would. And what do you think happened the moment I was gone? The moment I had given up, the moment my capital was on the sidelines and my mind was 1,000 miles away. Cotton began to move. It did not just move, it exploded. It began the great bull run I had foreseen weeks earlier. The line of least resistance had finally declared itself to be upward, and I was not there. All the waiting, all the analysis, all the certainty was for nothing. I had been right about the destination, but I had jumped out of the train because I was bored with the journey. I paid for my vacation with the millions of dollars I would have made by simply sitting still. I let the market's quietness shake me out of a fortune. This is the first lesson of the quiet market. Its primary purpose is to separate you from your conviction and your money before the real move begins. It is a test of patience, and the market makers know that 99 men out of 100 will fail that test. They will become restless. They will force trades that are not there. They will trade for the sake of excitement. They will mistake gambling for speculating. A quiet market is a siren song, luring you onto the rocks of overtrading. It will convince you that you need to make things happen. The rule is this. Your job is not to make the market move. Your job is to wait for it to signal its move, and then act on that signal. In a quiet, sideways market, there is no signal. The market is telling you in the clearest possible language to do nothing. It is telling you that the great powers of supply and demand are in equilibrium, and to bet on either side is to flip a coin. The professional speculator listens to that message. He conserves his capital. He conserves his emotional energy. He sits, and he waits. The amateur speculator cannot stand the silence. He has to play. He wagers on the wiggles and is inevitably ground down by commissions and small losses, ensuring he is financially and mentally unfit to take the big position when the time finally comes. When the market is quiet, you must be quieter. People who wish to make a living from this game constantly ask me for rules, for secrets. They want a formula. They believe there is some hidden key that unlocks the treasury. The truth is far simpler and far more difficult to execute. The big money is not made in the buying or the selling. The big money is made in the sitting. It was never my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. I recall an old speculator, a man they called Old Turkey on the floor. He was a veteran of many campaigns. In the old brokerage offices, customers would sit all day watching the prices move on the big board. They would buy something, and if it went up 2 points, they would be tempted to sell. A friend would come over and say, "You should take that profit. You can always buy it back on a dip." More often than not, the trader would sell, pocket a tiny gain, and then watch in agony as the stock proceeded to run up another 30 points. But not Old Turkey. He would buy his line of stock and he would simply sit. People would urge him to take a profit and he would peer at them over his glasses and say, with a slight shake of his head, "Well, it's a bull market, you know." He wouldn't even look at the board. To him, the little jiggles, the 5-point reactions, they were just noise. He was not interested in the ripples. He was waiting for the tide. And as long as the tide was coming in, he saw no reason to leave the water. This is the mindset you must adopt to survive the quiet market. You must see inaction not as laziness, but as a deliberate, strategic position. Cash is a position. In a choppy, trendless market, it is the strongest position you can hold. When you are in cash, you have 100% of your capital ready to deploy. You have 100% of your mental clarity. You are not anchored to a losing trade. You are not hoping for a stock to come back. You are a general on a hilltop, watching the battle unfold, waiting for the precise moment to commit your reserves. A quiet market is the enemy of this mindset. It erodes your patience. You get the feeling that your cash is unemployed. You feel you are missing out. This is a cognitive error. Your cash is not unemployed. It is on guard. It is protecting you. A quiet market is a battlefield shrouded in fog. To charge into it is not bravery, it is a pointless gesture. You must wait for the fog to lift. You must wait for the line of least resistance to reveal itself. The rule is this. You must distinguish between patience and stubbornness. Patience is waiting for a predefined setup based on your proven method. Stubbornness is staying with a trade that is not working, or forcing a trade when no setup exists. In a quiet market, patience means sitting in cash. It means resisting the urge to gamble. It means understanding that the market will always offer clear opportunities later, and your job is to be ready for them. The amateur wants to trade all the time. The professional wants to trade only at the right time. The quiet market is, by definition, the wrong time. Your strategy is to sit tight, just like Old Turkey, until you can say with confidence, "Well, it's a bull market, you know." And if you cannot say that, or its opposite for a bear market, you say nothing and you do nothing. The entire art of speculation is based on the idea of betting on probabilities. We are risk managers, not fortune tellers. We wait for the evidence to stack up in our favor. I always look for what I called the pivotal point. This is a price level that, if broken, signals the start of a new move. The path of least resistance has been cleared. All my big money was made after a stock crossed a pivotal point. Before that point, I might make a small exploratory trade, a probe, but I would not commit my real capital until the market proved my judgment to be correct. Now consider the nature of a quiet sideways market. It is a market with no pivotal points. It is a series of false starts and failures. A stock will rally towards resistance, luring in the breakout buyers, only to fail and fall back into the range. It will drift down to support, drawing in the dip buyers, only to break it momentarily and stop them out before recovering. It is a machine designed to frustrate and confuse. It offers no confirmation. It gives no clear signals. To trade inside this chop is to wager on randomness. It is to abandon the entire principle of waiting for the odds to be in your favor. I learned early on that you must not anticipate. You must wait and react. You cannot will a stock to break its pivotal point. You must wait for the market itself to do it. And that breakout must be accompanied by an increase in volume, what you would see today as a surge of orders on your trading platform. This confirms that real money and real conviction are behind the move. A quiet market has no such characteristics. The volume is typically low and uninspired. The price action is lethargic. There is no force, no urgency. To trade in such an environment is to ignore the foundational principles of safe speculation. You are essentially front-running a signal that may never come. You are tying up your capital in a position that is going nowhere, accumulating risk without any corresponding evidence of a potential reward. This is what I call dead money. Not only are you not making a profit, but you are also incurring an opportunity cost. The capital locked in your stagnant trade cannot be used when a genuine opportunity suddenly appears in another stock or sector. The rule is this. The quiet market strategy is an observation strategy, not a trading strategy. Your job during these periods is to be a detective, not a soldier. You are not there to fight. You are there to watch, to study, to identify the key levels of support and resistance that are defining the range. You mark them on your chart. You set alerts for when those levels are broken, and then you walk away from the screen. You do not get hypnotized by the meaningless intraday fluctuations. You let the market do the work. Your plan is not, how can I make money today in this dull market? Your plan is, I will do nothing until the market breaks X or Y level, and then I will execute my pre-planned trade. This transforms you from a gambler reacting to noise into a professional waiting for his signal. There is another, more insidious danger in the quiet market. It goes beyond the small financial losses. It is the destruction of your mental capital. Successful speculation requires immense confidence, courage, and decisiveness. When the time comes to act, you must act without hesitation. A big position must be taken all at once. You cannot nibble your way into a fortune. This requires a clear mind and a deep reservoir of self-trust. A quiet market systematically destroys these qualities. By forcing trades and taking a series of small, frustrating losses, you chip away at your own confidence. You begin to second-guess yourself. The next time a real signal appears, you will hesitate. You will remember the last 5 times you bought a breakout and it failed. You will take a smaller position than you should. Or you will wait for even more confirmation, by which time a significant part of the move is already over. The market has trained you to be timid. It has conditioned you to expect failure. When I was right and made millions, it was because I had followed my rules and waited for the market to give me the green light. My confidence was high. I had no recent history of being chopped up in a sideways mess. I was rested. My judgment was not clouded by the frustration of a dozen pointless trades. I was able to act with the full force of my capital and conviction, because I had done nothing while the market was preparing itself. I had protected my psychological state as fiercely as I protected my bankroll. The amateur thinks he must always be in the market. He feels that if he is not trading, he is not working. This is the perspective of a laborer who is paid by the hour. A speculator is not a laborer. He is a hunter. Does a lion hunt all day long? No. It rests. It conserves its energy. It watches the herd. It waits for the weakest, the slowest, the most opportune moment to strike. It may wait for hours, perfectly still, doing nothing. But when it moves, its action is decisive, powerful, and effective. The rule is this: your emotional energy is your most valuable asset, more precious than your cash. A quiet market is a swamp that drains this energy. You must treat it as such. The correct strategy is not to wade in, but to go around it. This means closing your trading platform. It means focusing on research. It means studying past market cycles. It means going for a walk. It means living your life. You are the lion. You must rest. You must conserve your strength. Forcing trades in a dull market is the equivalent of the lion chasing field mice. It is a waste of energy that will leave you exhausted when the great wildebeest of a trend finally appears on the horizon. Protect your mind. The money will follow. In the end, the entire game of speculation can be boiled down to a single principle: survival. It is not about hitting the one glorious trade that makes you rich overnight. That is the lottery player's fantasy. The reality is a long, arduous campaign. There will be winning streaks and losing streaks. There will be bull markets and bear markets. And there will be long, quiet periods of frustrating inactivity. The man who survives is the man who knows how to adapt his strategy to each of these conditions. The strategy for a bull market is to buy and hold. The strategy for a bear market is to sell short and hold. The strategy for a quiet market is the most difficult of all for the human mind to accept. The strategy is to wait, to do nothing, to sit on your hands until your knuckles are white, to accept that for weeks or even months your business, the business of speculation, is simply not open for business. Think of yourself as the proprietor of a store. When a blizzard hits and no customers are on the streets, do you stand outside and try to drag people in? No. You lock the door, check your inventory, and wait for the storm to pass. A quiet market is a financial blizzard. The customers, the volume, the volatility, the trend, are all at home. To try and trade is to stand in the freezing cold and lose your health for no reason. The final and most important rule of the quiet market is this: you must define the market's character before you risk a single dollar. Is it trending up? Is it trending down? Or is it locked in a range? If the answer is the third, your primary objective shifts from profit generation to capital preservation. You must recognize that you are on the defensive. Your goal is not to score points. It is to avoid costly mistakes. Your playbook should have only one page, and on it is written a single instruction: wait for the breakout. Until that instruction is triggered by the market itself, you have no other duties. You are a soldier ordered to hold your position. You do not charge. You do not retreat. You simply stand your ground, which in the market means holding cash. He who masters the art of profitable inaction will survive to profit from the inevitable action to come. That is the secret. That is the entire game.